Hello and welcome to the Bullish on Business video series. We're just back from the Hamptons where we summered at East Hampton, Martha's Vineyard, and Nantucket. We hope that you had a productive summer as well. And from what I understand, the Ameriprise Conference in San Francisco was filled with beautiful people and beautiful sights in that city by the bay. Today what we're going to talk about is what's gone on in the investment world since we've been on hiatus. Specifically, what we're watching and instructing our clients to be wary of is really what's going on outside of the U.S. Based on the information that we've cobbled together, it appears that more than likely most of the bubble situations that we hear about may be outside the U.S. with specific references to what's going on in Canada, Australia, or Scandinavia as areas where real estate could potentially pose a problem in the near future. But more importantly, because it's a bigger economy, is what's going on with China. Now, I know some of you may think, well, is this a symptom of what's going on with the trade talks? But all of the charts that we have indicate quite clearly that the Chinese situation started slowing down at the end of 2016. Specifically speaking, China, on a corporate level, has more than twice the amount of debt per GDP that U.S. corporations have. Most of this debt has been given to corporations by governmental entities, and not so much through their traditional banking system, but also if you look at the money supply in China in the trillions, it is almost equal to that of the U.S., European Union, and Japan in aggregate. So China is facing several headwinds. Chief among those is the one-child policy that happened, I think, in the late 70s or 80s when it went into place, is coming back to haunt them. Specifically speaking, their labor force growth has went in reverse, and by the charts that we have, probably sometime next year or in early 2020, their labor force will actually begin contracting, mainly due to that one-child policy. Now, as you can imagine, those of you who have children watching this, that this isn't an easy fix, and it's going to be a multi-decade fix to get their labor force growth back to the numbers that have been traditionally associated with Chinese economy. Secondly, their productivity per employee is on a massively downward trajectory. I'll have been insert slides in this for you to see, but this happens to coincide with about the same time that China lifted some of the restrictions on the internet usage, that you see their productivity decline almost in a dagger-like drop. So if you look at the fact that you have a shrinking labor force, the productivity of your labor force is declining, and a mountain of debt, those three things line up to spell trouble in River City. That starts with T and rhymes with C, which starts with China. Now let's bring this back to the U.S. So what are we doing? How do you China-proof your portfolios? That's what we've been working on. One, you'll see in the investment lineups later, we probably have more small caps, typically smaller companies in the U.S. and also in Europe are more of a closed economy type investment, meaning they're not going to be suspect to trade spats or trade talks. Typically, they'll do business more locally in their own domicile. Most of the U.S. companies that are small, very few of them export. The ones that do may export a little bit to Mexico or Canada or the Caribbean, but they're mainly, definitely U.S. or North America centric. The same thing goes with their European counterparts. So that's one way. You want to also look at potentially defensive sectors, real estate. Obviously, it's hard to pick up part of Manhattan and move it to Shanghai. BXMT, you'll see, is in a lot of our models. That's continued to do well and hit highs. But real estate in general typically is a way to China-proof your portfolio. And then you can also start looking at defensive names. Healthcare, most of the healthcare stocks and indexes are going to be U.S.-centric. Another area, obviously, is utilities. One of the areas that we're probably most high on is water utilities, because we think you're going to see a big infrastructure push here in the U.S., hopefully once we get past this election. Another new addition there is the Macquarie Infrastructure Fund that we've looked at because of the same reasons. And then I think finally, what you can look at besides healthcare and utilities and small cap stocks and real estate is you may want to look at any other individual companies that would be more U.S. based or things the Chinese would not want to utilize. The victims of this potentially, and we've seen in the performance, has been industrial stocks. With the world of this kind of globalized supply chain where people don't really keep big inventories of what they need because it can come over in a ship, a plane, or a train in the next week, those stocks probably would have the biggest amount of risk to them. Other stocks that haven't performed well since the trade talks have come up have been surprisingly defense companies. Even though the budget finally passed, I think $717 billion defense budget, most of those defense companies are well off their highs. So that's probably the primary sector where you'd see some losses. Tech is a mixed bag because not all tech companies are in China. Google, for example, has been not allowed to come into China. Ben is using an Apple iPhone now. Obviously, parts of that are probably made in China and some assembly there. So, but definitely industrials. The other thing to look for is probably clothing. On the retail sector, where's your clothing made? One of the things that's coming back to bite China is they built this behemoth economy on the back of cheap labor, and they're being out-Chinaed by the likes of Vietnam, Indonesia, Thailand, and even Mexico. So you want to look for ways to protect your clients and kind of China-proof them at the very least. We mentioned Canada and Australia in the lead-up. You might want to look at any exposure there. And the main thing is, in those, one way for Chinese citizens to get money offshore is to buy real estate. If you look at probably two of the more accommodative jurisdictions that have the rule of law, democracy, besides the U.S., obviously you've got Canada and you've got Australia. And what's happened is with the Chinese money piling up, real estate has been kind of priced out of the market for the normal Australians or Canadians. And as rates are going up, and if the Chinese economy gets under some pressure, you might see some real estate bubbles burst in those locations. Finally, the U.S. dollar has kind of come on over the summer, really the last month and a half. You've seen the dollar trade appreciate, put a lot of pressure on some of the emerging market investments. We are taking lower positions in the emerging markets because a lot of their debt is denominated in dollars. That dollar strength has waned a little bit in the last 5 days of the time we've done this taping, but it's still stronger than what it was 6 months ago. And I know the president's trying to talk down dollar strength, but that might be something that's easier said than done. We'll be back in just a few short moments to go over our new investment lineup. Welcome back. As you can see by the attached decks, we've made some changes to our investment lineups. We spent really the first half of the year working on our fixed income pieces. Rising rates are definitely in, even though on a day-to-day basis, the 10-year Treasury, 30-year Treasury may go down. We do think rates are definitely in the ascent. So we made changes over the course of the first half of the year to look at fixed income investments that we believe can handle a rising interest rate environment a little bit better, and also in the alternative investments. One thing to note on the real estate, the BXMT is our main workhorse there. According to Grant's Interest Rate Observer, 94% of all the mortgages held by BXMT are adjustable. They are tied to 2-year LIBOR, and so that may be one reason even when rates went up, BXMT held its value better than most. So that's kind of a adjustable rate REIT, so to speak. On the fixed income, you'll see a lot of floating rate investments, both in funds and ETFs. That should speak for itself. We have utilized quite a bit of the Lord Abbett Inflation Protected Securities Fund. We think probably wage inflation is coming at some point once the slack and the unemployment numbers tighten up somewhat on the fixed income side. that we've used in this rising rate environment is the Mackay Shields convertible securities fund. I think it's MCNVX. You'll see that in a lot of our portfolios. Convertibles typically weather the initial rate hikes better than most investments. And finally, I think we've still had a smaller position in traditional bonds. We've taken that down just to have some stable prediction, stability in the fixed income space. One area that we've gone more to is the principal preferred fund, PPSIX. We spoke with our manager at our D2 event in Miami, and that was end of March, 1st of April. We started making those moves because I think the majority are floating rate preferreds in that fund. So there again, you get a little bit more of an additional, as rates float, you'll take advantage of that. On the stock piece, as I said in the intro, we've gone more to small stocks and really tried to work our way down on emerging market exposure, primarily on the strength of the U.S. dollar. Those things typically wax and wane. I would say if you have younger clients that are adding to positions, I would probably keep the emerging markets because the volatility will actually work for them, as you know, as a dollar cost average. But with any type of turmoil that's gone on, especially in these trade discussions, the dollar has strengthened. And you might even see that index, the strong dollar index, UUP, in a couple of the portfolios as well. On the equity side, we have been, as I said, U.S.-centric, looking at more of the smaller cap exposure. We use a lot of the DCCIX, I believe that's a Delaware fund, some Virtus small cap funds as well, and then obviously the IWM. Occasionally we will sort for some individual securities, but on the small cap space, that's kind of few and far between. And you'll see too in a lot of our models, we've utilized the Vanguard VUG as kind of a growth driver to offset heavy value positions that are generating income for clients, but in order to kind of keep their statement above water, we want to balance that out with growth. With that said, we always think a balanced portfolio is appropriate, and try not to get overloaded in one type of sector or style of investing because things can change rapidly. And we do think we'll have some more volatility as the year goes on, but everything that we read appears that we may have, 10 to 14 months of pretty good economic sledding ahead, especially here in the U.S. But we'll focus on what goes on in the election, any type of collateral damage coming out of that, and just as long as the numbers keep showing up good with earnings as well as projections, we think the U.S. market is probably going to be one of the better places to invest globally. Enjoy the spreadsheets, and we'll see you next time at the Bullish on Business web video series. Thank you.